So, but today, let's go back to angel investing. And for my panelists, I would like you to briefly introduce yourself while answering this first question. So, for each of you, what does your group invest in, at what stage, and what does a typical check look like? Alex, let's start with you.
Great. Hi, everyone. Thanks for having me. Alex Kimmet. As mentioned, I'm a director at 37 Angels. We are an angel network made of about 100 plus angels, mostly around the United States. We really invest in seed stage companies. We focus on companies with at least 6 months of customer data and typically 50 to 500K ARR. It's sort of our sweet spot. About 80% in the technology sector, B2B, B2C, B2B2C, or B2C2B, whatever the letter in order is there. We tend to avoid the sort of big hit, one-hit wonder type companies like movies and some of those things that really, it's sort of binary, the success. And we also tend to avoid companies that are going to require very long investment cycles and a lot of capital to get going, like life sciences, like some of the clean energy things that you see. And that's really what we're focused on. 37 Angels is also really founded to educate angel investors. A big part of our program is the actual class that we hold to introduce individuals to angel investing, how to think about diligence, how to think about venture math, which is always a fun topic, how to think about portfolio strategy. And most of our members come through the class that is held several times a year and learn from that, and then we'll join our network afterwards.
Thank you. John?
Hi, everybody. Thanks for inviting me. I'm Jo Ann Corkran. I am the co-CEO of Golden Seeds, along with my partner, Arina McCarthy. She does all the membership stuff. She's brilliant at it. And I work on the deal side. So we are a nationwide network. We have about 300 members. We have sort of 9 clusters around the country. Our claim to fame is that we were the first angel group that only invested in companies that had at least one woman in the founding team. Because when Golden Seeds was started 20 years ago, women were only about 5% of the entrepreneurs out there looking for funding. Now there's something like 35%. And we feel like we had a lot to do with that. Also, at that point, only about 5% of angel investors in the U.S., which is a couple 100,000 people, were women. And now it's again something like 40%. Our membership is about 78% women. The rest, well, they let guys in. They have money and occasional expertise. The cool thing about our membership is that we have essentially nobody who inherited their money. All of our members are professionals, cashed-out entrepreneurs, doctors, lawyers, actors, people who made their own money and bring their own experiences to us. Because we invest in companies that have one woman, we don't have a sector bias. I will tell you, though, that women get about 38 to 40% of the STEM degrees in the U.S., but those STEM degrees are disproportionately in bio and life sciences and chemical and electrical engineering, so we see a lot of companies that have that kind of basis. I was just looking at what we invested in the last 16 months to give you an idea. We did 3 B2C companies, only 11%. We did about 30% healthcare companies, 3 med devices, 3 diagnostics. We don't really do biotech either because of the huge amounts of dollars. And the rest were B2B companies. About 6 of them were in like climate, energy tech, what else? Ecological stuff. But again, we don't do anything that requires you building a factory or something like that. We're looking at other kind of services and gizmos. We did 3 defense contractors, early stage, and what else? And a couple other deep tech companies. And we only did 3 software as a services companies, which is a big change because, you know, what are they calling it, the SaaS apocalypse? And the 3 SaaS companies that we did invest in were all companies that were working on edge applications for AI. So that's who we are, and what else did you want to know about us?
That's good. Well, I'll ask more later. But thank you. Thank you. Yaniv?
Hi, my name is Yaniv Sneor. I'm one of the founders, at this point the only remaining founder of the 3 of us who started Mid-Atlantic BioAngels. As you saw by the finger pointing, we do life science. We only do life science. We are a life science angel investor group, and we were formed and created with the mandate to exclusively invest in life science. It's a really difficult area to invest in. And it's a really difficult area to develop a mandate as to how and where you can make money in it, which we think we've developed our own thesis to do that. And we only go after the deep science and deep data stuff. And because of that, we were able to attract the membership that is primarily from the industry. So all of our members have a day job, and that day job is usually working for the pharma and device companies, or they're doing work in regulatory or commercial work in life sciences primarily. Our membership is now worldwide. Our companies have always been worldwide. So we should have changed our name from the first day, but we didn't. So we just concentrated more on the BioAngels than the Mid-Atlantic stuff. We invest between $250,000 to $1 million per round, but the stages of the companies that we invest in, we don't go by the traditional Series A, pre-seed, etc. We call it the first professional round is when we would consider investing in a company. And that is when there is somebody who can understand and tell us they know how to monetize the opportunity in a convincing way to us. So when it's beyond a scientist in a dream, but somebody who can say, this is how I can take this science and make money from it, that is the earliest we would consider an application. And then one of our mandates is, because we're trying as angel investors to make money in an area where has been alluded to can be require huge checks in the future, we're looking for opportunities that can get to an exit without large VC checks in the future. It's difficult to find those purple unicorns, but we think that we do have a way to find them. So because we don't want those large VC checks in the future, we do expect to participate in all the rounds until the exit. So the earliest would be that first professional round, whatever you want to call it, all the way to an exit.
Interesting. Okay, thank you. So let's continue talking about angel investing as an asset class. So angel investing is always often lumped in with venture capital, right? But it behaves quite differently as an asset class. How should an investor think about angel investing in terms of risk, return profile, time horizon, and liquidity compared to, let's say, public equities, private equity, or VC funds? Any one of you?
Happy to take it. It's a high risk, potentially high reward, and it has benefits and disadvantages versus other equity areas. One very significant benefit that we all share is the Section 1202 of the tax code, QSBS, wherein if you invest in a qualified U.S. C Corp, and you hold that investment for at least 5 years, now it's 3 to 5 years, they're changing the law, all of the earnings on that investment up to, I think, the greater of 10x or $15 million
yes.
will not be subject to tax.
Federal
tax.
tax. And of the 50 states, I believe 47 follow the feds on this.
So that is a huge advantage of that asset class. Should you take the mortgage money and your kids' tuition money for college and put that in this asset class? You should not.
How much you like your kids.
For those of us who like our kids. But We believe, and I think that we haven't spoken about it, but I think that the philosophy about angel investing is that you're building a diversified portfolio as an investor, right? And you have stocks, and you have bonds, and you have whatever it is, and some of it should be alternatives. Whatever you're comfortable with, some of it should be alternatives. A nice part about these kind of alternatives is they don't follow the market. So the stock market can go up and down. We don't follow the market the same way, right? There is no liquidity, so you invest the money, and it becomes a religious experience in a way that you hope and pray. The companies will actually make money, but if you do enough diligence, you increase your chance. And if you engage with those companies and you help them, you further increase your chance. If you specialize, you further increase your chance as well. So there's different ways to hopefully increase your chances. And also, if you're investing your own money, as opposed to VCs who invest other people's money, I believe we also increase our chances as well. So there's just a few points.
Yeah, I agree with all of those. I also think that pick a number, and everybody has to pick their own number. Is it 5% you want in this asset class? Is it 7%, 10%? You have to be prepared to lose that money, and you have to be prepared that it's illiquid. And within that 5 to 7%, in my opinion, you have to have diversification. And I don't think you have to have 100 opportunities, but I think you have to have 10 or 12 at least. So.
Yeah, I think that you two have covered it quite well. It is a very high-risk, high-reward asset class. It can be a lot of fun getting in with early-stage companies and watching them grow and scale. It is an asset class that the liquidity is definitely a challenge. So be prepared to have your capital locked up 5, 7, 10, maybe more years, which can make it a little more challenging. But it is, I enjoy it, and you get to meet a lot of interesting people, a lot of very brilliant founders that are very passionate about solving things in new ways, and I think that's one of the things that's most exciting about it. And at the angel level, you get a lot of interaction with those founders because half or 3/4 of their job is raising capital initially because they need capital to succeed. And so one of the things that I've enjoyed about it most is that learning process and speaking to different entrepreneurs.
Thank you. So in terms of just to make the math work, how many investments should an angel investor make in order for this to make sense financially? Like in your experience.
If you look at statistically, and the angel groups invest a lot more than us because we're so focused, you see the numbers that they publish, like there's the Techos Angels that publish their numbers. If you create a portfolio of companies where you invest an equal amount of money in every company, and that company is not just one-off where one person thought it was a good idea, but it was supported by multiple people, if you look at the entire portfolio and even count the failures, you're looking at a 5x, 6x return on your money, is what they've shown. So the idea is create a portfolio. Create an engaged discussion around selecting the right opportunity, whichever way you do it internally for your own group, whatever your mandate is. And then if it's big enough, you increase your chances. Because if you only pick one or two, you might miss a lot, and they may not be the right ones. But if you create a big enough, your own portfolio, we created an internal fund and an outside fund. But internal fund, by definition, has multiple companies in it, so that you make sure you create diversification internally.
And there's lots of, I don't know how good all this data is, but there's lots of data out there. And if you look at the data, it basically says that something like 1/3 of these companies, you're not getting any money back. And then between 10 and 15% of those companies are going to be the bulk of your returns. So that's why you need to have a diversified portfolio. And a great venture fund has a 30% return, and those are sort of like the 30 to 40% is what most of the angel groups who have good returns are looking at. And if you could compound your money 30 to 40% every year, you'd be a very happy camper.
And I think, as you mentioned, you probably need a minimum of 10 investments to see those kind of returns because diversification really is crucial and in being spread across that asset class. think something like 50% of venture returns don't return anything to their investors. So it is very high risk and high reward. And I think part of that is also just because of the types of companies you're investing in, going back to your previous question, there's just a lot less information. These companies have very little other than a business plan and maybe a little bit of customer data. It's not like there's years of financial history at the seed stage at least. It's not like there's a ton of market traction. So when you're talking about early stage investing, you really want to diversify or partner with individuals that have a lot of expertise and experience in the space, because it can be a wild ride.
And you're not doing discounted cash flows. Definitely not.
Our companies have no cash flow. When we invest in a therapeutic company, they will never sell a product.
Okay, so I think this is a good way to kind of start talking about advantages of specialization, because I think here on this panel we have a unique opportunity to hear 3 different specializations, right? So first, Yaniv, let me ask you, Mid-Atlantic BioAngels is explicitly sector-focused on life sciences, right? Which is one of the most technical and capital-intensive areas in early-stage investment. So what does this deep specialization unlock? I mean, in terms of diligence, deal flow, support for the founders that a more generalist group simply cannot replicate.
We didn't want to leave it up to chance as to who would be in the room to diligence a life science opportunity. We wanted to make sure that we attract people who have the stomach for and the expertise in that specific industry. So we said that we would specifically not do the general stuff, and we would only do the deep data, the deep science stuff, which allows people who have an interest in the area and who have experience in the area to be part of the group. So at this point, we have 60 plus members with expertise developing similar assets, as working for big pharma or device companies, acquiring some of these assets we are looking at on a regular basis, or as consultants in regulatory commercialization who have that expertise as to how these assets generally behave. And the belief is if you get enough expertise, enough people with enough diversified background around the table for a very active discussion, you're going to end up most of the time with a better kind of a decision. I mean, it usually works out even with things that people don't necessarily know about. You have enough people in the room, they can probably come to a good decision. So we forced that, and our job as a group is to create a very robust discussion. So we have an internal pool, which is a fund, where most of our members belong to the pool. And they vote how the pool should invest the pool's money. But when you vote, everybody can see how you vote, and you have to post a statement that says why you voted the way you did. And that's going to force you to interact with the diligence, to be part of it, to write a rational statement about why you did what you did, and it creates a very engaged discussion within the group. And you're encouraged to try to change people's minds or to challenge what other people are saying, because only then can you actually end up with at least an open eyes type of decision.
Amazing, thank you. So Jo Ann, now question for you. Golden Seeds has built its thesis around women-led companies and has data showing strong performance. So how does this thesis-driven focus sharpen both deal sourcing and investment decisions? And what have you learned from about the returns from that particular focus?
Well, I would say it's pretty obvious that it's helped us with deal flow, because we're one of the biggest angel networks out there, the most active. When we started, we didn't have any deal flow, but now because we have a good reputation and people know that this is a place where we try to interview women without the explicit bias that they might see at some other firms, we have really great deal flow. However, we see all those companies. We do something almost exactly what you do when we're looking at companies. The idea is that we have multiple sets of people talk to a company to come up with what might be good and what might be bad, and then we bring in more people who can fill in the gaps on what we didn't know in the first set of discussions, and then we do it again. The great thing about having a lot of members where we know what they did, where they worked, who they know, we can source through that pool. It's a lot of work. I mean, it's the same thing you do. Our members volunteer to write a finding of the 6 or 8 points about the company, and then that's shared with all of our members. And it's just as important to have a group who kills companies quickly as it is who gets companies over the finish line. Because you want to find the flaws, and if you can't figure out how to help the company get over the flaws, and some of them are just fatal flaws, you need to move on. So it's a very similar process to yours. And we do like these deal memos. So you asked about deal flow, about diligence, and what do we know about returns? So there's this thing in angel investing, you may have heard it, where people always say, do you bet the horse or do you bet the jockey? I.e., is it the idea or is it the management team? And it would be wonderful to get a great jockey on a great horse. Never happens. So I would say that one of the things that has been a theme through our years is people are foremost, because nothing ever goes exactly as planned. The crap hits the fan, and you need to have people who can work through problems and can go out and fish to get what they need. And so I would say that's the most important thing.
Okay, thank you. So Alex, 37 Angels has been intentional about activating new, and often women, angel investors. How does specializing in who invests rather than what you invest in shape the portfolio and the network effects around it?
Absolutely. So I should have mentioned 37 Angels was founded by Angela Lee, and the name originates from the fact that when she founded the company, I think 13% of angel investors were women, and she wanted to close that gap to 37%, which is how she got to 37. And the idea was to really educate new angel investors on how to think about venture investing and what are the things that you need to look for and what do you really need to understand in order to diligence a company. And as I mentioned, a lot of the members that we have go through the course that she teaches and that I teach, and it's really about, I guess, putting a framework around how we think about diligence and what to look for in companies and what makes a good company and how do you choose from all this noise on who do you think that's going to succeed. Angela is a former consultant like myself, so we love alliterations, so it's the 4 Ps. People, are you betting on the right jockey? This is incredibly important. Problem, is the problem that the company is trying to solve, is it big enough to actually have a company where you can generate the returns that you want? Product, we like to actually see customer data. And does a product exist? Is it in some shape and form, or is it yet to be built? And then price, which is always a lot of fun when thinking about venture because there's no DCF or multiples or anything that you can really do. And price really comes back, do you think that this company can take enough of a market share in order to generate a 10x, whoops, sorry, that would be my dog's medicine that he's supposed to be getting. So apologies, I think I put my phone on silent. And can you generate the 10x return, which is really this multiple that we like to target. And because of that course, we bring in people from all sorts of backgrounds as well, doctors, lawyers, entrepreneurs, corporate individuals, consultants, just people from all walks of life. And I think that has been mentioned, getting people with different experiences in a room to speak with companies, to ask questions based on their experiences, you can really learn a lot more about a company and get a lot more of a perspective about what's going on, and also provide more of a network effect, because you've got a broad network, and all the angels have their broad networks too. They can introduce potential customers or advisors or employees or whatever it may be, and I think that is a lot of value that can be added in the early stage investing as well.
Okay, thank you. So let's talk about how and why angel investors is different from like traditional like VC investment or other types of investments. So here's a question. So when a founder has a choice between taking in an angel round and going straight to institutional VCs, what should drive that decision? What do angels offer that VCs typically don't?
So VCs and angels have different models, and different angels have different models as well. But the general model of VCs is that they have a fund. A fund has 10-year life, and during those 10 years you need to identify the companies to invest in, you need to make those investments, and you need to harvest those investments in those 10 years. So everything has to be done because they need to return the money to their limited partners, to their LPs. So for that reason, you have to, as a founder, understand where you are in the life of the fund. Because if you're in year 6 of the fund, you only have 4 years worth of life left in your company before somebody forces a liquidation on you. And the way that they force a liquidation is by owning at least 51% of the company, which means they can fire the CEO and they can force a sale. The other thing is that they are investing other people's money, and they usually invest a lot of money, so they prefer to write very large checks. So that is different than the model of, and they have to deploy their funds. So angel investors, we can invest when we like something and not invest when we don't. When we do have funds, they're not necessarily closed-ended, and they have long returns. We tend, usually an angel round is considered to be 20 to 40% of the company. The company will sell 20 to 40% of itself during an angel round. We rarely take ownership of a company. We rarely change them. In fact, the reason why it's so important for us to invest in the management team, because we don't have the power usually to get rid of them. And so we're in for the ride. And we want to make sure that they know what they're doing. So we invest usually smaller amounts as well, $250,000 to $1 million per round. We could invest up to maybe $3 or $5 million over the life of the company, and we have. And it's much more patient money. And we obviously don't take control over the company in such situations. So those are some of the major differences between VC and angels. In our industry, there are companies that are going to require VC money, and they have no other choice. If you need $50 or $100 million to develop a drug, you're going to have to go to VCs, but we ask the companies not to come to us. We will not invest ahead of VCs because they tend to like to squeeze us during those later rounds in order for them to make returns. So we look for companies that will not require those VC rounds where we believe we can actually make money without future heavy dilution from VCs. Regular dilution, yes, not large VC dilution.
Okay, so you hit on one of the things. I'm freezing, by the way. Could you give me my jacket?
Sure.
There's one over there. I think I'm right under it.
I think there's a vent.
A vent right above us. Thank you so much.
You're the lucky one. It's getting more back here.
Okay. So the biggest thing is that angels tend to invest smaller amounts. Let's say $250,000, that would be like our smallest, up to, I don't know, half, $750,000. And we'll do follow-ons as well. But let's say we're talking to a company right now that has its technology out of the University of Massachusetts. They have a matching grant, and they can get to the first prototype from bench level with, $1.5 million. They need $750,000, and the rest of it they can get from Massachusetts. So they don't want more money than that because they want to make this prototype, and then the company will be worth more when they go out to raise a bigger round. So they'd be sort of dumb to go to VCs, and they know it, they've come to us. And I would say that's the first big thing, is that companies, they're early stage, they have a couple of big milestones that they want to get to, either in technology development, or if it's healthcare, some phase of their either regulatory or something, or if it's software as a service, it's finding that, being able to prove that you have product market fit. You don't need that much money to do that. And that raises your value when you go out for a larger round, which is more oriented to, say, a growth strategy or to accomplish something that requires much money. So that's the biggest thing. You put in less money. Although I do want to say that VCs are now spraying in, was very derogative. VCs have now moved down market, and I was looking at Y Combinator and General Catalyst invested in 30 companies last quarter. So there is a move to push money down to our sizes.
Mm-hmm.
And I think another potential advantage, in addition, so a lot of VCs will require board seats at a certain level, and giving up a board seat early on can be a dangerous proposition if you don't have the right board member as well. Some angel groups might require that. However, I would say it's not the norm. So that could be another reason for the other reasons that were mentioned as well, is just you're giving up sort of less control in some ways, or oversight.
Okay, thank you. So now let's talk about decision making, right? And you've touched upon this already, but now if there's anything you want to add, because I understand decision making for like an angel group looks very different from a decision making for at the level of a micro VC or a larger traditional VC fund. So can you walk us through your deal decision-making process from the beginning to the end? How does it look?
Okay, so
You want to change the...
You wanna go?
Oh, no, you're good.
So
I'm happy to go as well.
So we're not a registered investment advisor, okay? That's not what we do. We don't have an LPGP kind of situation. Our members come together, they work in groups, they get information from the other members, and then they decide if they want to invest in a company. We will set up an SPV for 200,000 or something like that, because companies like to have one name on the cap table. Because they want to keep it clean, and it's frankly easier for members. So that's how we do it. Everybody has to make their own decision. And that is why one of the things that I think, if you are going to even think about becoming an angel investor, you should go check out a couple of groups, go sit through a couple of diligences. Do not write any checks until you have seen a variety of deals and have a sense of how things work. Get your own mind in order about what you think is really important on the deal. Because it's not like interviewing a manager and then saying, hey, I feel like this guy knows what he's doing. I'm going to give him $500,000 and let him go do it for me. Mm-hmm. It's very different.
Okay, got it.
So our process end-to-end, we have 2 investment associates at any given stage that get a lot of inbound, either from our angel investors or through the website, and screen probably 500 to 1,000 companies every 2 months. And of that 500 to 1,000, we talk to 10 to 20 a week. And then of that subset, we invite 8 to a pitch day. And our angels will come together. Those companies will pitch. The members will then vote on the 3 companies to go into deeper diligence with. The angels will divide into teams and conduct diligence with those companies and write investment memos. And those investment memos will then be shared with the broader network. And our angels make individual decisions We're actually not one name on a cap table, so we don't have an SPV. Our angels are all individual investors on a cap table. Some companies don't love that, but it's how we operate. This, going back to your previous question, one of the other advantages potentially of going to an angel group like ours is decision making can be a lot faster. From the time that a company pitches to when they get a decision from our group, it's less than 4 weeks, which is very speedy, and you wouldn't get that if you were going to raise money from a venture fund as well. But that's our investment process.
So we put our investment criteria on our website, and we ask all the companies, even the ones that are referred to us by our syndication partners, to go to the website, review it, and to first screen themselves. So, and when we go to conferences, and we do a lot of conferences around the world, most of the time through Zoom, we spend most of the time not listening to pitches, but pitching in reverse to the companies and telling them what we're looking for, and trying to help them decide whether they should spend the hour or so to fill out our questionnaire and go through our process. And when they do, there is a screening committee that meets on a monthly basis, and it's open to all of our members, and we encourage all the members to come and to participate in that, because it's one of those things that the more you interact with a group, the more you get out of it as an individual as well. So see how our criteria are at work, you know. And so we screen all the companies once a month. And with that said, only 20 out of 100 of the companies that we screen make it through to presentation in person or over Zoom. And we actually did Zoom pre-pandemic because we always invested around the world. Of those 20 companies, when they present, in order to move into diligence, at least 5 people and a lead must commit to the diligence before we even move into diligence. So that means that usually about half of those companies don't go into diligence. So 10 out of 100 now go into diligence. Within a week of the company's presentation, they will get their first set of questions, and those questions will be those go, no-go questions. We don't want to waste anybody's time. They have to be the critical questions up front. Let's not waste, let's get to it right away. If we're concerned about if we can make money, if we're concerned about how the product works, whatever it is, we want to know right away. We want them to know that it matters to us right away. And then if the diligence continues, it means that we're still getting good enough responses to our questions. If the diligence committee is still positively inclined after a number of rounds, we will bring the remainder of the pool members into the diligence room. And our diligence is the conversation that we have in that room. We have a platform called Basecamp, where all the conversations happen there, where we put in articles, we put in data, we put in comps, we put all the stuff that our members know and put in there. We summarize it, and we say, and any other questions you need, because we have to prepare for a vote. The vote is algorithmic. So we know that if we hit a certain threshold, or if we don't hit a certain threshold, no investment. If we meet a minimum threshold but not a top threshold, we end up with a minimum investment. And if we get to the top threshold, which means broad support of the opportunity, we have the maximum investment. The maximum is 20% of the money you put into the pool, which means you're guaranteed at least 5 companies every time you put money into the pool. You're guaranteed a broad type of portfolio from that. But it's all algorithmic. There's no investment committee, there's no advisors. It all ends up with that kind of discussion. And then based on that, we make the investment decision. About 1.4 of 100 companies receive funding from us. Usually when they do, it opens other doors because we are sort of picky in a way in terms of what we like to invest in. But we tell companies, even if we don't invest in you, doesn't mean that you're not a good company. You're just not right for us. It's very important that everybody knows that. So we don't talk about the companies we don't invest in. We don't want anybody to realize that we passed on somebody because I don't want them to think that they're bad for any reason. It's just not within our very narrow, very focused criteria. And in addition to that, we have a sidecar fund. It's a co-investment fund for people who don't have the time or expertise to be members of the group, but they want to co-invest with us. So that's also algorithmic. If we make a 20% investment, it makes a 20% investment. Everything goes through one SPV, and everything goes to the company that way. Members are still welcome to write their own individual checks if they want to, but most people would rather go through the board.
Okay, thank you. So So now let's talk about the specific deal terms. First, safes versus private. Oh, wait. Safes versus price round. Pro rata rights, board seats, I guess I know, information rights. What are you looking for? What is a must-have, or perhaps, or whatever? Tell us about the investment terms.
Okay.
Go ahead, Laura.
We do write term sheets for about 20% of the deals that we do. And we see about 1,000 companies a year, and last year we invested in 17. So we do follow-ons though, so we did more than 17 investments. If we have a company that it's obvious that this company is going to have to take in multiple rounds of financing, we would prefer to do an equity round with the set of paperwork that comes from the National Venture Capital Association. It's really cheap to use that paperwork. It's already there. There's only a certain amount of things that you have to fill in. We have law firms who will do it for us for a pathetically small amount of money because they use it as marketing to try to get clients. So many entrepreneurs are so terrified about giving up some control. They don't want a board. Well, I'm not investing in a company that doesn't have a board, so that's sort of a non-starter. We won't invest in a company where we don't have information rights. Why would we ever do that? So we would like to get a priced equity round using NVCA. We'll compromise on that somewhat. It's almost always just, non-participating preferred, the simplest stuff. We will do convertible notes, and although we hate them, we do on occasion do SAFE, a simple agreement for future equity. I'm not exactly sure why people fall for that, but yeah.
And pro rata, you also have pro rata typically.
Yeah, we typically want pro rata, but I mean, if it's a note, I think it's a little overreach to ask for pro rata. But if it's an equity round, we definitely want pro rata.
What about observer seat? No.
Frankly, my opinion is that entrepreneurs, once they realize that an early stage board is going to include 1 or 2 people with expertise in their area, and they realize they get free labor and free advisors, they all want a board. And if they're so paranoid about that, they may not be the people that you want to invest in.
We prefer not to do safes because in order to get to a simple agreement for future equity, which is a safe, you strip out all the investor protections and you strip out all the governance from the company. And we want to invest in professional companies that are properly governed, including board of directors. So if the one case that we did a safe, we wrote side agreement,
That's what we do.
back into the safe everything that was stripped out of it in the first place, which makes no sense. But we prefer not to do it, prefer to do priced rounds. I mean, I think that we have enough expertise in the room to negotiate an actual value for the company and not kick the can down the road, but we will do convertible notes. A board of directors seat creates a fiduciary responsibility between an individual and a company, where the individual is beholden to the company first and to us as an investor second. And they need to understand that, and they need to understand the risks and the legal consequences of that relationship that they have with the company. So we tell people to make sure that they have D&O insurance in place, that they're comfortable with their situation, with having dual hats perhaps sometimes. And so we offer it when it's offered to us sometimes, but we can't make anybody do it. What we do is we create a liaison relationship between our members and the company that we invest in. Rather than wait for the companies to call us when they have issues or whatever, or when they're raising money, which usually they're very busy, they forget to call us. They only call us when they need money. So now we reach out to them once a month or once a quarter, and we say, how are you doing? What are your challenges this month? Do you need any help? Any resources? Any doors we can open for you? So just to reach out on a proactive basis to say, we're invested in your success. How can we make you successful? You know?
Arina, I have a question. Given the makeup of Maine, the Manhattan Alternative Investment Network, and what we're trying to do as far as creating a network, what we try to do is help startups with our service provider network, and we have several in each category. Do you leverage groups like ours for service providers, which obviously, companies, whether they're startup or not, they need accountants, lawyers, other types of advisors, cyber, whatever. Is our group something that would be helpful in the angel investor community?
We have service providers who are sponsors, and we actively connect them with our members, and we encourage them to offer them benefits to our members and to the portfolio companies to see if they can assist them in any way. And they interact with us and with the companies as well. We do have people who are in their day job service providers, but if they are and they are investors, they can't charge the companies for their services. If they want to be a liaison and they want to interact with the company and they want to provide their expertise, great. But they do it as an investor time and expertise.
Alex, any restrictions on investments or any?
Sorry.
Oh, sorry.
I
Yes.
have a question on the bio side. So I have a situation where the product is bio, it's pharma. It's a pain relief product. It's been successful in 35 countries, but he needs capital now to bring it to the U.S. to get the FDA approval, go through all the phases. His ask isn't that much to get through the phases. So my question is really, what's the law? Is that an angel type of investment, or is that a VC?
Pain is for the VCs. It's a very difficult industry, very difficult indication. A lot of people going after it. There are political and legal ramifications in the pain space. Very tough one.
What is an opioid alternative?
Many of them are, and there are a lot of alternatives out there. And if he thinks that he doesn't need a lot of money, then he doesn't know his true commercial path ahead.
Well, he's asking for 5.
He's going to need a lot more.
He's
It's
going to need a
VC
lot
deal.
more to go to market. I know that.
Okay, so we'll continue more specific discussions afterwards, but I would love to hear about 37 Angels and what you invest in. What are the terms?
Yeah, absolutely. Priced equity is preferred. We do invest in safes, not unless they're capped. Never invest in an uncapped safe. That is a
It's
major...
just like, why would you do that?
Exactly, just giving somebody money and that's really
Hoping that
praying.
they do an equity
Exactly,
round.
exactly. They have no incentive necessarily to go raise another equity round. We don't ask for board seats. Some of our members have joined boards though, and been asked to join boards just based on their expertise. Pro rata rights aren't a requirement for us, but we will take them every once in a while as well.
And info rights.
In information rights, we do prefer information rights and ask for them. And in most of the cases, if you're investing early, you want to know what the company is doing and how they're doing. So it's
It's
important.
also, we write a side letter where we ask for information rights, even if it's in the docs, because the next guy tries to get it out. So we have a side letter, and in that side letter, we say that we want unaudited quarterly financials. We want the board-approved budget before December 31st or whatever their fiscal year is. And we want a narrative of performance versus the budget. And then we hand the companies what a narrative looks like. And it's basically 6 bullet points on we met these benchmarks, we exceeded these benchmarks, we flopped on these. That's all we need to know. And you would be amazed at how hard it is for some companies to manage to give you that. And part of it is that these companies are under a lot of pressure, trying to do a million things. They have all the problems that every company has, and there's 6 people there. But if you don't keep investors informed, your chances of getting more money from them start to drift down. So Well, at the 15-day limit, if we haven't gotten that report, we're on the phone.
Okay, and thank you. So I have one last question before we open the room up questions. What are the ways to get engaged with your particular group? How does it start? Like for the audience here, like if they decide to, see if they can become members of your organization. What are the steps?
So for us, 37angels.com, we would encourage you to sign up for a course to learn about angel investing. And but if you don't want to do that, we accept members that haven't signed up for that course as well. We think it's a great opportunity to learn about how to think about angel investing. I do think it's important also, there's a lot of angel groups out there, and you should do your own research and see what really suits your personality, your investment profile, whatever it is. And just look at a number of different groups. We obviously prefer ours, but you can also, there's no harm in joining more than one. Different groups also have different terms, whether they be membership fees or management fees or percentage of carry or whatever it are. It's important to understand those terms as well.
Yeah, so we hold something called an open house. It's a Zoom meeting. I think we do it twice a month, where we talk about what membership is at Golden Seeds. That's a good way to spend a half an hour and find out. And then you should come to one of our forums. That's where we have companies that have gone through the 3 or 4 rounds of vetting, and it's when they're first exposed to a large number of members. About half of the companies make it through that, and then they go into diligence. But the nice thing about that is not only do you see some companies, but more importantly, you see our membership, and you see the interaction between our professional members and the companies. And again, I suggest you go to a couple of groups, see what they're like. Don't write checks the first couple of times. Learn. We have 9 different courses that we talk about different aspects of investing, including different sectors, investing things to look for. And then go out for cocktails and get some more stories.
Okay, works.
For us, we do get blind inquiries sometimes over the website. People just send information to info@bioangels.net. For people who, usually it's introductions from our members. We interview every person ahead of time. We have a call with them, a Zoom call, to make sure it's a fit. Rarely, but sometimes you get people that just you see that won't work in the group. It doesn't happen very often, once every few years, but you see a different kind of personality. Maybe because we all have group dynamics, and the social element of the group is very important to people, the network that they create, the interaction, and then they feel more comfortable in the investment process, everything they do. So it is important to check out the group. So if we, the people that we interview and them interviewing us, believe that it's a good fit, we invite them to a meeting so that they can see what the dynamic looks like, and then after that, they either want to be part of it or not, which is fine, either way. We do run background checks on all of our members as well, and then hope that they want to be part, and we encourage them, if they do join, roll up your sleeves and get involved in as many possible activities as you can of the group. The diligence, the screening,
Yes,
you
it's
name
not
it.
just writing the check, right?
Right.
For any of your groups.
Get involved.
It's more involvement than that. Okay, so then I have one final question for you, in one sentence each, please. Here's the question. So what is the one thing about angel investing you wish more people understood, and one thing you wish fewer people believed?
Okay, so the one thing that I think they shouldn't believe is that it's a get-rich-quick. Okay, and what was the other question?
The one
thing that they should know
Mhm.
is I have more fun doing this than I had in my collective 35 years on Wall Street.
I
So,
love that.
yeah.
That's inspiring. Alex, yeah?
I would say that the one thing that I think everyone should know is you are gonna not bat 500 or probably even 300 or 200. I think a lot of investors think that they're the smartest guy in the room and they're gonna outperform everyone else. I'd love to meet that person if you know him. So I think that's the one thing that I would, I think people should know, or the advice that I would give. The one thing that I think they should know, I got involved in angel investing similarly because I had a corporate job that I hated and wanted to do something in my spare time that I knew I would love, and I started working with 37 Angels and haven't looked back since. And it was nights and weekends and early mornings, but I love it. I love meeting entrepreneurs and just learning how people are thinking about solving problems in this world today and building businesses in this world today. It's a lot of fun.
Absolutely. Yeah?
I think I would expand on everything that's been said here, that angel investors are naturally curious, people who want to engage in intellectual pursuits that involve, because when you look at what makes a company successful, you have to look at so many different elements, from the money and the technology and the regulatory in our case and the people, and it's a really interesting puzzle. And the people that I think that we end up having the joy and opportunity to work with as our members, naturally curious and naturally want to engage in this. And I think it was a surprise to some of the people. One of our companies sold to Stryker for just over $500 million. And when they were in that process of selling themselves, they were talking to another major company. And when that company was told that the major investments for this company who came from angel investors, they discounted it because they're like, what do you guys know? What would angels know? But the surprise is that angel investors have tremendous amount of expertise in them. And so there is quite a bit of knowledge, quite a bit of expertise, and if you're naturally curious, it's a great place to be.
Thank you so much. Now, any questions? Sorry, I kind of dominated with my questions, but please feel free. Yes.
Excellent question, by the way.
Thank you so much. Yes.
Thank you so much. This was a really great panel. So I think a few of you alluded to kind of the frameworks that you look at when thinking about investing in a company. But within your framework, I'd be curious to hear what typically inspires most confidence in a company, and kind of the other way around. What inspires least confidence that you try to avoid?
Same answer for all of us, right?
Probably.
Go ahead.
The founder, at an early stage investing, you're betting on the founder as much as anything. And you want somebody that, or we want somebody at least that we're confident in. If they're an exited founder, great. They have a certain level of expertise is incredibly important. And what does not inspire confidence is if that individual won't take feedback. It's great to have a confident founder, but they also have to be able to listen as well.
Yeah, you want people who know what they don't know. And that's, yeah.
Okay, any other questions? Oh, okay.
Yeah, I have actually many questions, but I'll stick to one for now. We'll probably talk over the cocktail. Exit strategy. And it's probably not, yours is very focused, but exit strategy, do you keep that in mind? And has exit strategy changed over the last couple of decades? So do you, so what do you, when you invest, do you have certain perspective on that investment
Yes.
in mind?
We want to know how we're going to get money back. Yeah, so we focus on that. And we want to hear what the entrepreneurs have to say about it. We encourage companies to have exit on every board meeting. You don't have to devote a lot of time to it, but who's going to take you out? One of your competitors, one of your customers, one of your vendors, and if it's not a specialized kind of company. And so that should be on your board meeting every month. We love companies that are already, we're talking about a company right now, that it's early science. Dow Chemical's following them around like a puppy dog. That's interesting to us. We don't want Dow Chemical to run this round, but we want to know that there's strategics out there that they're smart enough to be focused, going to strategic and making these relationships early on. So yes, that's one of the things you want to know.
Can I ask a follow-on to his question? Do you have a preference to IPO or M&A?
Oh, let's come on. IPOs, that's like 3 to 4% of companies that ever return money. You don't want a goddamn IPO.
Right.
And you certainly don't want to be tied up in an IPO after it goes. So M&A.
There you go.
You had a question.
Yeah,
Sorry.
you know, with
No,
the
no, it's
pan-
perfect. Perfect setup.
with the panel's experience in taking the horse and the jockey analogy out of it, looking specifically at seed stages, is there a structure that the funder can put in place that is more incentivizing for you? And I actually take this from the bullet point narrative that you mentioned. So if they did a gated tranche for their seed round, and each gate was unlocked by developmental milestones at the beginning, would that entice you to look at the company more thoroughly, or, you know, that way?
So, I mean, we've seen deals like that. We wouldn't necessarily write a deal like that, just because it's just more paperwork.
Fair.
If you need, you know, $700,000 to get to this first milestone, we'll give you $700,000. We'll write a term sheet for $700,000. Then we can write another term sheet. It's, you know,
Makes sense.
I love lawyers. I just don't want to pay them to write paperwork for me on easy stuff.
I like that attitude.
Yes, yes.
Do you find that you are going in as the exclusive seed funding, or is there a wider groups of individuals and other seed funder companies like yourself going
So
in?
we very much, and I don't know about you guys, but we very much, if we lead a deal, that's great, but a lot of time we're just seeing deals from other people. Angels are very much cooperative folks. We work in syndications. So like I have, you know, a defense deal, I know that I'm going to go to the engineers at B&A, Band of Angels, and they're going to look at that deal. If it's a medical deal, I know where I'm going to go with that. If it's whatever, you know. But it's not our job to complete the round. It's the entrepreneurs. So we will help them by giving them a list of people that they can call and tell them that we'll share our diligence. But one of the skills that you have to have on your team as an entrepreneur is how to squeeze money out of rich people or venture firms. And we look for that.
We do have a syndication network, and when we do make an investment decision and the company is interested in it, we'll send out an email or we put a press release that we've invested in XYZ company. And if there's additional information they'd like, we'd love to tell them about it.
I think it's very rare for one company to take down an entire seed stage.
Okay.
Just a quick one. If they've gone through the family and friends round, that's when you would give it a serious look. And then I have a follow-up question.
When there is a professional person who knows how to monetize the opportunity driving the company, that's when we would consider it, not until and unless.
Okay. And my follow-up on that is many of us in here are also on the capital raise side. Obviously, I am. We could probably live off of your crumbs of what you accept, what you don't accept, but have analyzed, and the why. How often are you involved? It's a good deal, it's a good opportunity, but it's just not a good fit. And then you'll help them maybe to the next stage or not. It's time-consuming, but it's more of a service-oriented type of thing to do that.
We will tell every company that we say no to why we said no. And at the bottom of our questionnaire, we say, if you're reapplying, tell us what you did to address the issues we noted last time. We don't want to speak about those companies or publicize the fact that we didn't invest in them because they may not be right for us, but may be great for somebody else. So we tell them that, and they can do with that information whatever they want to do. They can reapply in the future if they want to, and if they think that those things that we said no to weren't deal killers. But that's as far as it goes.
That's almost
Is that
identical
pretty much
to
the
what
same
we do.
with all
Yeah.
three of you?
And
I don't
Peter,
know.
you had the last question.
I'm just curious if Mid-Atlantic Bio or Golden Seeds makes the model deal document that corrects, the side letter that corrects the deficiencies of the safe available online.
No,
No?
no.
You want to share it on the
Got to
Side-
become one of them.
But I'm telling
No,
you,
you make
it's,
me pay Fox to do it?
it's really easy.
Yeah,
You just,
look whatever's missing from the, look,
just
compare
fill
it.
it in there.
Everything's
Compare it
missing.
to a convertible
Everything's
note.
missing.
Everything's been taken out of the convertible note, put back
Go
into
to
the
the
safe.
protected provision section of the convertible note and write it in there.
There you go, okay.
Okay.
The Angel Capital Association also wrote a model for, I think, one of your partners.
Oh, they wrote a
The Fox
model
Rothschild,
convertible,
convertible note for the
convertible
ACA.
note, convertible note, model convertible note.
and
That's
I
fine.
heard that they might come up with a model safe, but there was a big argument about it at the ACA because a whole bunch of
You don't want safes.
angels won't do that, so.
You don't want to encourage safes in any way.
No saves them. Okay, well, thank you so much.
Thank you.